2023 has been a great year for investors. So far, the S&P 500 has already went up 6%, Nasdaq 12%. Even Tesla, which was dropping 70% over the past year, stopped dropping and went up over 65% within a month. What ah? Which brings us to the question, has the market already bottomed at the end of 2022? According to the post which I did last week, over 48% of you guys feel that the market crash is not over yet, while only 21% believe that the crash is over. So, which one is correct? In this video, I'll be showing you some data to help you determine whether the bottom is already here or whether the market could jiba-boom and crash even more. Alright, let's first take a look at the technicals. Last week, the S&P 500 broke out of two very strong resistance. First, it broke out of a long-term descending channel, which started all the way back in December 2021. You can see that every time the S&P 500 touched the top part of the channel, it goes back down. It happens a few times until last week, where it touched the ceiling and broke right through it. Not only that, the S&P 500 also went above the 200-day moving average. That's why when the S&P 500 went above these two trend lines, there was a super strong movement in many of the stocks. Google up 11% year to date, Facebook up 20%, and of course Tesla up 65%. And mind you all these companies are big companies that have a huge market cap, and it's not easy to pump them up. And yet, they've already gone up by so much. So, does it mean that the crash is over? The bulls will tell you that the breakouts in strong resistance levels have a very high 75% success rate. And sure enough, in the past, there were many breakouts that led to new all-time highs. Then, the bears be like, a high success rate doesn't mean 100% success rate. There were also quite a few breakouts that failed, but probably the biggest bearish indicator we have is Jim Cramer tweeting, "What a comeback for the mighty Dow, really impressive," and the market could crash back down. Just kidding. Both the bulls and the bears will have their arguments. On one hand, the bulls will say that the breakout will signal that the crash is over, and will show you all kinds of data to prove their points. And on the other hand, the bears will say that this is your usual buy the rumor, sell the news kind of setup. Bear rallies are common, and there's no way that the stock can go up 500% in this kind of economy. Quick pause, here's a short message from today's sponsor, Moomoo Singapore. Right now, we are in the earnings season, and with Moomoo, you can easily keep track of your favorite company's earnings. Here's how. In the app, go to Markets, Earnings Reports, you will be able to see all the upcoming earnings dates. If you want to find out more, you can tap on the stock, financial, and under earnings, you'll be able to see a quick breakdown of the latest result, earnings call transcript, and what do other people think about the result. So, if you are interested, you can sign up using my link down below, deposit $2,700 or more, and you receive a free stock worth up to $200. Besides that, if you invest at least $100 into Moomoo Cash Plus for 10 days or more, you will receive another $20 cash coupon. With that being said, let's get back to the video. Okay, maybe the technicals are not a good way of looking at this. Then, how about looking at what the Fed says? After all, the whole reason this crash started was because of the Fed saying that they wanted to raise interest rates in order to fight inflation. And based on history, whenever the Fed pivots, there will be a market crash. But so far, the Fed has already said that they are not planning to pivot this year. So, does it mean that this market rally is just a fake rally? As it turns out, listening to the Fed may not be a reliable indicator, because they have been wrong a few times in the past. The reason this inflation went up so high in the first place was because the Fed was slow to react. Back in 2021, there were warning signs that inflation could get out of control, but the Fed be like, "Aiyah, this inflation is just a transitory inflation, and it will go away by itself." Spoiler alert, they got it wrong. They later admitted that this inflation is no longer transitory and had to raise interest rates fast and furious in order to catch up to the high inflation. Also, if you look at the Fed projections back in March 2022, most of the Fed officials had only expected to raise rates till 2% by the end of 2022. But now, we are already over 4%. Look. Also, back in 2007, the Fed famously said that the US economy was on track for a soft landing. And the market went and crashed another 50%. I don't know about you, but that doesn't sound like a soft landing to me. In summary, the Fed is not a reliable indicator as to where the market will go. That's why even though the Fed has warned that big rallies will prolong the pain, the market be like, rally some more for you to see. And it's even pricing in a Fed pivot by the end of the year. Okay, how about looking at certain market indicators which may help to determine where the market bottom is? First, S&P 500 tend to bottom at around 12 to 13 PE ratio, though that's not a reliable indicator as there are times where the market has bottomed even before reaching there, like in 1945, 1961, 2001 and 2020. Then, how about looking at the weeks indicator? The market tends to bottom when there's capitulation. Analysts have found that no bear market has ever bottomed without wicks reaching 45 or more. Right now, the wicks is only at 18.5, which is nowhere near the maximum pain level. So, does this mean there's no capitulation yet? I don't know. Because there are signs that retail investors have sold off all of the S&P 500 and Nasdaq stocks which they bought over the past few years. And there was definitely some capitulation going on with Tesla investors back in December. So even if the VIX hasn't spiked up to the maximum pain level yet, the capitulation may have already happened. Then, how about the fact that the market has never bottomed before the recession begins? Unfortunately, this may not be a reliable indicator, as 1, we may not enter into a recession, and 2, even if we did enter, the market did bottom before a recession, before World War II. So, if the Fed and market indicators are not a good sign where the market will go, what is a good indicator then? Economic data. Okay, let's check it out. The inflation rate has been consistently falling, except for the egg prices which suddenly shot up. All jokes aside, most of the stuff that contributed to the high inflation is now coming down. Food prices are now lower than when the Russian-Ukraine war started. Oil prices have gone down too. Same for gas prices, which are all lower than when the war started. The main thing that isn't coming down yet is shelter, which accounts for 1/3 of the inflation. But shelter prices lag by 4 quarters. So with rent growth trending downwards and home prices falling, shelter prices will eventually come down by the second half of the year. Besides that, the job market is still very strong. Non-farm payrolls rose 223,000 in December, while the unemployment rate is extremely low. So, all those are good news for the bulls. But then, bears be like, don't forget that the yield curve has been inverting for a super long time, and that means a recession is coming. Also, personal savings rate is at an all-time low. Companies are firing thousands of employees and there will be an earnings recession soon. So the market will crash. Hold up, the bulls have the perfect counter to these claims. Yes, the yield curve has inverted. So what? With the economy being so strong, even if a recession comes, it may just be a mild recession. Personal savings rate at all-time lows? Again, that doesn't mean anything. It only means that many people are still happily spending money because they believe that things will still turn out alright. And even though real earnings have dropped, it is still way higher than in the past. Companies laying off thousands of employees? That's just because they were aggressively hiring prior to 2022 and are just trimming off people who are not critical to the business now. Also, people who were laid off were actually able to quickly find new jobs elsewhere. That's why the unemployment rate didn't rise significantly despite all those layoffs. How about earnings recession? There are data which show that earnings decline doesn't always mean falling stock prices. Though, one thing that's worrying is that household debt has skyrocketed and that is a strong indicator of an impending economic downturn. So not everything is sunshine and rainbows, yeah? So as you can see, there are no clear signs whether the market bottom is already over or not. But if you look at the economic data, things have certainly improved as compared to last year. However, with all kinds of big events happening this week, like the Fed meeting, manufacturing data, jobs and unemployment data, and S&P 500 companies report earnings, anything can happen. The market can easily go up another 10% or crash back down. Then how? Okay, instead of trying to find the bottom, let me share a better strategy. As you all know, the market goes up and down every day, right? But if you break it down, it always follows a certain cycle from optimism to euphoria to fear, surrender, and back to optimism. Back in 2020 and 2021, we were at the euphoria stage. That was when stocks were going to the moon every day. But right now, we are definitely nowhere near the euphoria stage. However, one thing is for certain, we are somewhere at around the bottom part of the cycle, whether it's fear stage, surrender, or optimism stage. I have no idea. But it's never about buying at the bottom. It's about buying when it's cheap. And right now, things are definitely way cheaper as compared to last year. Who cares where the market bottom is? Market up, you buy. Market down, you cry a bit, then you buy more. As long as you can keep doing that, then hold the stocks over the long term, and by long term, I mean at least 15 to 20 years, you will do well. Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.